Good morning and welcome to today's live. We are going to do chapter 17 of The Intelligent Investor by Benjamin Graham. And the chapter is 4 extremely instructive case histories. My name is May Doldow. My blog is yesfinanciallyfree.com. So if you haven't already, go to this blog, yesfinanciallyfree.com. Put in your first name and your email address on the right side and subscribe to the email list. Because I sent the email list instructions on exactly when I was going to be live, what I'd be talking about. So the best place to know what's going on is to be on the email list. Now, you also get a free ebook, Working Parents Guide to Financial Freedom, when you subscribe, and you can unsubscribe at any time. But there's so much good content on this blog, you need to check it out. Okay, I'm also going to be live on Instagram, and I forgot my phone stand. So there you have it. So I'm going to put Instagram on live as well, and we will continue. But a little bit about myself. So hold on, let me just delete this. Delete, go live, delete. And we are live. Okay. All right, guys. So I want to tell you about myself so that you understand why I do these lives and why I'm reading this book by Warren Buffett. So like I said, my name is May Doldow, right? My blog is yesfinanciallyfree.com. I started blogging a while back, but I want to let you know that I used to be really bad with money, and that's actually one of the reasons I started learning about it, obviously, and then also I started blogging about it to keep myself going and motivated and learning more and more and more about money. So I was blogging when I had a job at a bank. I was blogging when I had a lot of debt. I was blogging in 2011. I wasn't blogging yet about this in 2011, but in 2011 I had over $40,000 of debt. All right, that's kind of when I hit my bottom. Okay, I had so many different credit cards, like at least 8 different credit cards, lines of credit. Interest rates varied, but they were high. You know, the lowest one was like 8% or something. So, and it just wasn't easy for me with money. Okay, I had a lot of difficulties, challenges. 2016, paid off all that debt. Quit my job, had increased our net worth, my family's net worth by $500,000, and we're making about $500 a month in passive income every month from dividend yielding stocks, mostly. In 2017, I had 3 masterminds, Finance Freedom Mastermind. I was coaching clients in how to, that's Jordan, by the way, he's my son, he's 6, coaching clients how to pay off their debts, but also, more importantly, increase passive income and net worth. Focus on that instead of the debt, and then gradually become richer and create more freedom in their lives. I also went on 1 month of vacation. We went on a cruise to Mexico. I'd never been on a cruise. It was like one of my dream. I made an actual meditation sequence about going on a cruise because I really wanted to go. Yeah, so I made it and I would listen to it from my phone and visualize being on a cruise, and finally got to go on a cruise 2017 for 1 week to Mexico. I'd never been to Mexico either, right? And then we went on vacation to LA, Washington, DC, Toronto, Niagara Falls, Buffalo, New York. It was just awesome to see my family and friends again from all over and visit new places, do new things. We bought our first condo in 2017, a condo in Waikiki. We bought a second condo in 2018, another condo in Waikiki. And we converted, we had 2 Airbnb businesses. We sold one to our manager, who's also a Finance Freedom Mastermind member, right? We trained him on how to be a manager, sold it to him. He has his own investment property now. And we used the proceeds to buy this house, this condo in Waikiki, which is just 2 blocks to the beach. We go there almost every day. It is gorgeous weather here in Waikiki. I live here with my son, Jordan. You saw him already. My husband, Jamal. And that's pretty much my story. Okay, so I share it because I want you guys to realize that if you're not good with money and you don't understand anything about money, you can change your life and you can change to become better with money. Okay, you can change your lifestyle. Let's say you're like me and I was a parent and I didn't want to be at a full-time job, come home, be exhausted, and not have time to be a good mom, right? or a good wife because I was too tired. So quitting that job saved us so much money. When I took Jordan out of school when he was 3, he turned 4 the next month, but I took him out of school. He was getting sick all the time. Took him out and he didn't get sick for a whole year. And the month I took him out, that month or the month before, whatever, the co-pays we paid on our medical bills was $600, about $600. So that's a huge amount of money to be paying in medical co-pays, right? That's because not only does he get sick, I got sick, my husband got sick, and when a little kid is sick, you don't sleep, right? When he doesn't sleep, you don't sleep. It's just that way. So when he got better, we all got better. We all saved money. So that's like what? At least $500 something of savings a month, every month, right? Plus, but more importantly, is our quality of life is better. I sleep more. We all sleep more. We all healthier, right? Life is better. That's what I'm about. I'm about improving lifestyle, improving quality of life so that you have more energy. You focus it on what you want to focus it on, like maybe your children or your family, your husband, your wife. Instead of focusing on like making enough money, focus on enjoying your life and focus on what you want to pursue in life. So that's what YesFinanciallyFree.com is all about. So no matter where you are, if you're struggling with money or not, you can learn a lot there, create a different lifestyle, change the way you live your life, and become financially free. Yeah. So that's why I recommend it. Go there, get on the email list, first name, email address on the right side, gets you on the email list, free ebook, Working Parents Guide to Financial Freedom, and you can communicate with me. All right. I answer my emails. So I do check emails. And so if you want to talk to me, that's the best way to talk to me. Okay. And you can unsubscribe anytime. There's also a products page on YesFinanciallyFree.com where you can see all the products we have. We have the 7-Day Finance Freedom Challenge. If you don't make any passive income right now and you want to learn how, it's a 7-day challenge. Emails, follow the instructions. In 7 days, you'll be making 2 streams of passive income, one from a high yield savings account, one from your first dividend yielding stock of your choice that you pick and you trade. So it's a really simple program, but it's only $7. And it's a great way to get started because a lot of people make 0 passive income. Plus, the 7-Day Financial Freedom Challenge will get you focused to make a financial freedom goal. It'll instruct you how to do it, how to write it out, where to put it, what to do with it. Okay, so it's really instructive and important basic training. It's only $7, guys. If you want to get even more support, we have the 1-year Finance Freedom Makeover, which is a year of recordings of one of my mastermind groups. Yeah, a year of the recordings. These are real people with real monetary struggles. We go through all the basics of how to become financially free for a whole year because it takes a year to see real results in your net worth, your passive income, and to see your habits really change and your mindset really shift. So there's a year's worth of videos, 1 video a week. You get that for $97. That is a steal. But not only that, right now there's this running bonus where if you sign up for that, the 1-year Finance Freedom Makeover, it's only $97, guys. You can get on a weekly Q&A with me every week on Wednesday at 6:15 a.m. Hawaii time, 12:15 p.m. Eastern time. Oh, I think I did my conversion time wrong on my email. Anyway, it's all good. So you can get on live with me once a week, every week, and then I can help you with anything. If you have questions on the video training, you're like, I don't know how to do this, that. I had one lady come on who signed up for the 1-year Finance Freedom Makeover, and she had a question, and I answered it, and she's all happy. So, and that's just something you can do for a whole year. You can access me live and ask any questions you want. So that's a great program, $97, steal. It really is. If you want even more help, we have coaching with a Finance Freedom Coach. Once a month, we help you do your numbers. What are your numbers? We help you track your cash flow, your net worth, your passive income generation, and your financial freedom account, which is your investment account. Basically, you're keeping track of your income statement, your balance sheet for yourself, your personal life. We help you do that by just helping you. If you have questions, we get online with you on a Zoom and we just help you calculate it all. That's all. And if you need passive income, we help you figure out next steps and what to do. And then the next month, we check in on you. So it's really good accountability. It's really good if you want hands-on, if you're too lazy to do it yourself, but if you know if someone's there, it's kind of like if you go to the gym and you need a physical trainer. Right? It's the same kind of thing. So if you're interested in that service, it's $197 a month. Now, if you want the ultimate package, that's the Finance Freedom Mastermind program. That's what I started in 2016, 2017. What it is a group of individuals we get together every week, and all we do is help each other become financially free as quickly as possible. It's the most powerful program we have because it's a mastermind group. Mastermind groups are super powerful, guys. So we get together on a Zoom, online, okay, on a Zoom, and we do a specialized training for the group every week for 40 minutes. It's recorded, so you can watch it anytime. You also have access to the Q&A every week. So does the $197 a month program, guys, by the way. Same thing. You always have access to the weekly Q&A. So if you need extra help, I'm there. But Finance Freedom Mastermind members also get invites to like the annual Financial Freedom Christmas party on the 24th of December in Hawaii, and they get lots of other benefits. They can text me, they have my phone number, they can ask me questions. Not that I answer text right away, but they have more access to me, all right? And it's just a more powerful group. It's more fun. We get to know each other. It's called Finance Freedom Mastermind. All these products are at yesfinanciallyfree.com under products. Okay? So I'm going to read the chapter now. Chapter 7, The Intelligent Investor by Benjamin Graham, 4 extremely instructive case histories. And the reason I'm reading this book is because Warren Buffett recommends it. He's a really good investor. And I'm always looking to improve. And I've never read this book. And I realized that after reading it, a lot of things about my investing over the years, why it hasn't worked out, why my stocks have devalued or fallen in price. And I realized that it's all in this book. So a lot of people might think this book is dated because it's written in 1970. Hold on one second, guys. I got a call. Hold on. Hi, Jamel. Good morning. I'm on a live. Is he here already? Okay. Okay, bye. That was my hubby. Okay, moving on. I started this live early because my husband wants to repair his car and he wants me to go get the mechanic and all that. Okay, so let's do this. So Warren Buffett's smart. I want to be better investing, so let's begin. And I hope you do too, so that's why you're here, right? This book, even though it's written in 1972, is still very relevant. 4 extremely instructive case histories, chapter 17. The word extremely in the title is a kind of pun because the histories represent extremes of various sorts that were manifest in Wall Street in recent years. They hold instruction and grave warnings for everyone who has a serious connection with the world of stocks and bonds, not only for ordinary investors and speculators, but for professionals, security analysts, fund managers, trust account administrators, and even for bankers who lend money to corporations. The 4 companies to be reviewed and the different extremes that they illustrate are Penn Central Railroad Company, an extreme example of the neglect of the most elementary warning signs of financial weakness by all those who had bonds or shares of this system under their supervision. A crazily high market price for the stock of a tottering giant. Ling Temco Val Inc., an extreme example of quick and unsound empire building with ultimate collapse practically guaranteed, but helped by indiscriminate bank lending. Well, that sounds familiar. NVF Corp., an extreme example of one corporate acquisition in which a small company absorbed another 7 times its size, incurred a huge debt, and employing some startling accounting devices. Aaa Enterprises, an extreme example of public stock financing of a small company, its value based on the magic word franchising and little else, sponsored by important stock exchange houses. Bankruptcy followed within 2 years of the stock sale and the doubling of the initial inflated price in the heedless stock market. The Penn Central case. This is the country's largest railroad in assets and gross revenues. Its bankruptcy in 1970 shocked the financial world. It has defaulted on most of its bond issues and has been in danger of abandoning its operations entirely. Its security issues fell drastically in price, the common stock collapsing from a high of 86.5 as recently as 1968 to a low of 5.5 in 1970. There seems little doubt that these shares will be wiped out in reorganization. Our basic point is that the application of the simplest rules of security analysis and the simplest standards of sound investment would have revealed the fundamental weakness of Penn Central System long before its bankruptcy, certainly in 1968, when the shares were selling at their post-1929 record. and when most of its bond issues could have been exchanged at even prices for well-secured public utility obligations with the same coupon rates. The following comments are in order. Number 1, in the S&P bond guide, the interest charges of the system are shown to have earned 1.91 times in 1967 and 1.98 times in 1968. Hi, Wise Mama Studios. Welcome. Thanks for being on the live. Where are you from? I'm reading this book. I read this book every day, every weekday, until it's done, and almost done, actually, to become a better investor. Okay, so I'm going to sneeze probably. The minimum coverage prescribed for railroad bonds in our textbook security analysis is 5 times before income taxes and 2.9 times after income taxes at regular rates. As far as we know, the validity of these standards has never been questioned by any investment authority. Yes, honey. Yeah, they're going to fix the car later. Go brush your teeth, sweetie.
Are they gonna meet me?
No, go brush your teeth. Okay. As my son, his name's Jordan. As far as we know, the validity of these standards have never been questioned by any investment authority. On the basis of our requirements for earnings after taxes, the Penn Central fell short of the requirement for safety. But our after-tax requirement is based on a before-tax ratio of 5 times. With regular income tax deducted after the bond interest, in the case of Penn Central, it has been paying no income taxes to speak of for the past 11 years. Hence, the coverage of its interest charges before taxes was less than 2 times, a totally inadequate figure against our conservative requirement of 5 times. 2. The fact that the company paid no income taxes over so long a period should have raised serious questions about the validity of its reported earnings. 3. The bonds of the Penn Central system could have been exchanged in 1968 and 1969 at no sacrifice of price or income for far better secured issues. For example, in 1969, Pennsylvania Railroad 4.5s due 1994, part of Penn Central, had a range of 61 to 64.5, while Pennsylvania Electric Company 4 3/8 due 1994 had a range of 64.5 to 72.25. The public utility had earned its interest 4.2 times before taxes in 1968 against only 1.98 times for the Penn Central system. During 1969, the latter's comparative showing grew steadily worse. An exchange of this sort was clearly called for, and it would have been a lifesaver for a Penn Central bondholder. At the end of 1970, the railroad 4.25 were in default and selling at only 18.5, while the utilities 4 3/8 closed at 66.5. Number 4, Penn Central reported earnings of $3.80 per share in 1968. Its high price of 86.5 in that year was 24 times such earnings. But any analyst worth his salt would have wondered how real were earnings of this sort reported without the necessity of paying any income taxes thereon. 5. For 1966, the newly merged company had reported earnings of $6.80 a share, in reflection of which the common stock later rose to its peak of 86.5. This was a valuation of over $2 billion for the equity. How many of these buyers knew at the time that so lovely earnings were before a special charge of $275 million or $12 per share to be taken in 1971 for costs and losses incurred on the merger? Oh, wondrous fairyland of Wall Street, where a company can announce profits of $6.80 per share in one place and special costs and losses of $12 in another, and stockholders and speculators rub their hands with glee. A railroad analyst would have long since known that the operating picture of Penn Central was very bad in comparison with the most profitable roads. For example, its transportation ratio was 47.5% in 1968 against 35.2% for its neighbor Norfolk and Western. 7. Along the way, there were some strange transactions with peculiar accounting results. Number 1, see, for example, the article 6 Flags at Half-Mast by Dr. A.J. Brilloff in Barron's, January 11, 1971. Details are too complicated to go into here. Conclusion. Whether better management could have saved the Penn Central bankruptcy may be arguable, but there's no doubt whatever that no bonds and no shares of the Penn Central system should have remained after 1968 at the latest in any securities account watched over by competent security analysts, fund managers, trust officers, or investment counsel. Moral: security analysts should do their elementary jobs before they study stock market movements, gaze into crystal balls, make elaborate mathematical calculations, or go on all-expense-paid field trips. Ling Temco Vault Inc. This is a story of head over heels expansion and head over heels debt, ending up in terrific losses and a host of financial problems. As usually happens in such cases, a fair-haired boy or young genius was chiefly responsible for both the creation of the giant empire and its ignominious downfall, and there is plenty of blame to be accorded others as well. The rise and fall of Ling Temco Vault can be summarized by setting forth condensed income accounts and balance sheet items for 5 years between 1958 and 1970. This is done in Table 17.1. The first column shows the company's modest beginnings in 1958, when its sales were only $7 million. The next give figures for 1960. The enterprise had grown 20-fold in only 2 years, but it was still comparatively small. Then came the heyday years to 1967 and 1968, in which sales again grew 20-fold to $2.8 billion, with the debt figure expanding from $44 million to an awesome $1,653 million. In 1969 came new acquisitions, a further huge increase in debt to a total of $1,865 million, and the beginning of serious trouble. A large loss after extraordinary items was reported for the year. The stock price declined from its 1967 high of $169.5 to a low of 24. The young genius was superseded as the head of the company. The 1970 results were even more dreadful. The enterprise reported a final net loss of close to $70 million. Stock fell away to a low price of $7 1/8. And its largest bond issue was quoted at one time at a pitiable 15 cents on the dollar. The company's expansion policy was sharply reversed. Various of its important interests were placed on the market, and some headway were made in reducing its mountainous obligations. Okay, so he has table 17.1. So Instagram, if you want to take a look, screenshot that, you're welcome. And then here, there it is, table 17.1, Ling Temco Vault Inc. Okay, so in the table, it's in millions of dollars except earned per share. They have the operating results of different years from 1958 to 1970. So the sales in 1958 was 6.9 million, and it went as high as $3,750 million in 1969, and then it dropped to $374 million in 1970. Net before taxes and interest, and he puts in the amount of sales, and it was less than, it was like $500,000 in 1958, $88 million in 1970, but it went as high as $124.4 million in 1969. Interest charges, 0.1 was estimated in 1958, and it went as high as 128.3 interest charges, $128.3 million in interest charges in 1970. Times earned. I'm not sure what times earned means, but he has times earned there. Income taxes. His income taxes, special items, net after special items, balance for common stock, earned per share of common stock. And then he has financial position, total assets, debt payable within 1 year, long-term debt, and stockholders' equity. And then I guess he's talking about the debt. So the assets, the total assets in the beginning were 6.4 million, and the debt payable was 1.5 million per year, and the long-term debt was 0.5 million. The stockholders had 2.7 million of equity. But in 1970, the total assets were $2,582 million. The debt payable every year was $301.3 million, and the long-term debt was $1,394.6 million. So the debt ratio was a lot higher. Ratios: Current assets and current divided by current liabilities. So in 1958, it was 1.27 times, and in 1970, 1.45 times. Equity divided by long-term debt, 5.4 in 1958, but in 1970 it was 0.13. Market price range in 1960 was 28 to 20. Went as high as 109, 169 and a half in 1967, but then it went down to 7 and an eighth in 1970. So that's the table. The figures in our table speak so eloquently that few comments are called for, but here are some. 1. The company's expansion period was not without an interruption. In 1961, it showed a small operating deficit, but adopting a practice that was to be seen later in so many reports for 1970, evidently decided to throw all possible charges and reserves into the one bad year. These amounted to around $13 million, which was more than the combined net profits of the preceding 3 years. It was now ready to show record earnings in 1962, etc. Okay, that was funny. 2, at the end of 1966, the net tangible assets are given as $7.66 per share of common, adjusted for a 3-for-2 split. Thus, the market price in 1967 reached 22 times its reported asset value at the time. At the end of 1968, the balance sheet showed $286 million available for 3,800,000 shares of common and Class A stock of about $77 per share. But if we deduct the preferred stock at full value and exclude the goodwill items and the huge bond discount asset, there would remain $13 million for the common, a mere $3 per share. This tangible equity was wiped out by the losses of the following years. 3. Toward the end of 1967, 2 of our best-regarded banking firms offered 600,000 shares of Ling Temco Vault stock at $111 per share. It had been as high as $169.5. In less than 3 years, the price fell to 7 1/8. Number 4, at the end of 1967, the bank loans had reached $161 million, and a year later they stood at $414 million, which should have been a frightening figure. In addition, the long-term debt amounted to $1,237 million. By 1969, combined debt reached a total of $1,869 million. This may have been the largest combined debt figure of any industrial company anywhere and at any time, with the single exception of the impregnable Standard Oil of New Jersey. 5. The losses of 1969 to 1970 far exceeded the total profits since the formation of the company. So basically, the company never profited at all. Okay. Moral. The primary question raised... Did you brush your teeth? Good job.
Hungry.
Hungry? There's oatmeal.
I want fried rice.
You want fried rice? Okay, let me finish my reading. Okay. The primary question raised in our mind by the Ling Temco Vault story is how the commercial bankers could have been persuaded to lend the company such huge amounts of money during its expansion period. In 1966 and earlier, the company's coverage of interest charges did not meet conservative standards, and the same was true of the ratio of current assets to current liabilities and of stock equity to total debt. But in the next 2 years, the banks advanced the enterprise nearly $400 million additional for further diversification. This was not good business for them, and it was worse in its implications for the company's stockholders. If the Ling Temco Vault case will serve to keep commercial banks from aiding and abetting unsound expansions of this type in the future, some good may come of it at last. The NVF takeover of Charon Steel, a collector's item. At the end of 1968, NVF Company was a company with $4.6 million of long-term debt, $17.4 million of stock capital, $31 million of sales, and $502,000 of net income before a special credit of $374,000. Its business was described as vulcanized fiber and plastics. The management decided to take over the Charon Steel Corp., which had $43 million of long-term debt and $101 million of stock capital, $219 million of sales, and $2,929,000 of net earnings. The company it wished to acquire was thus 7 times the size of NVF. In early 1969, it made an offer for all the shares of Charon. The terms per share were $70 face amount of NVF Junior 5% bonds, due 1994, plus warrants to buy 1.5 shares of NBF stock at $22 per share of NBF. The management of Charon strenuously resisted this takeover attempt, but in vain. NBF acquired 88% of Charon's stock under the offer, issuing thereof $102 million of its 5% bond and warrants for $2,197,000 of its shares. Had the offer been 100% operative, the consolidated enterprise would, for the year of 1968, have had $163 million in debt, only $2.2 million in tangible stock capital, $250 million of sales. The net earnings question would have been a bit complicated, but the company subsequently stated them as a net loss of 50 cents per share of NBF stocks before an extraordinary credit and net earnings of 3 cents per share after such credit. First comment. Among all the takeovers effected in the years 1969, this was no doubt the most extreme in its financial disproportions. The acquiring company had assumed responsibility for a new and top-heavy debt obligation, and it had changed its calculated 1968 earnings from a profit to a loss into the bargain. A measure of the impairment of the company's financial position by this step is found in the fact that the new 5% bonds did not sell higher than 42 cents on the dollar during the year of issuance. This would have indicated grave doubt of the safety of the bonds and of the company's future. However, the management actually exploited the bond price in a way to save the company's annual income taxes of about $1 million, as will be shown. The 1968 report, published after the Charon takeover, contained a condensed picture of its results, carried back to the year end. This contained two most unusual items. Number one, there is listed as an asset $58,600,000 of deferred debt expense. This sum is greater than the entire stockholders' equity, placed at $40,200,000. 2. However, not included in the stockholders' equity is an item of $20,700,000 designated seems to be, and include the other item in stockholders' equity, which it would normally belong. Then we have a more realistic statement of tangible equity for NVF stock, viz. $2,200,000. Thus, the first effect of the deal was to reduce NVF's real equity from $17,400,000 to $2,200,000, or from 23.71 per share to about $3 per share on 731,000 shares. In addition, the NVF stockholders had given to others the right to buy 3.5 times as many additional shares at 6 points below the market price at close of 1968. The initial market value of the warrants was then about $12 each, or a total of some $30 million for those issued and exceeded in the purchase offer. Actually, the market value of the warrants well exceeded the total market value of the outstanding NVF stock. Another evidence of the tail-wagging dog nature of the transaction, the accounting gimmicks. When we pass from this pro forma balance sheet to the next year's report, we find several strange appearing entries. In addition to the basic interest expense, hefty $7,500,000, there is deducted $1,795,000 for amortization of deferred debt expense. But this last is nearly offset on the next line by a very unusual income item. Indeed, amortization of equity over cost of investment in subsidiary, $1,650,000. In one of the footnotes, we find an entry not appearing in any other report that we know of. Part of the stock capital is there designated as fair market value of warrants issued in connection with acquisition, etc., $22,129,000. What on earth do all these entries mean? None of them is even referred to in the descriptive text of the 1969 report. The trade security analyst has to figure out these mysteries by himself, almost in detective fashion. He finds that the underlying idea is to derive a tax advantage from the low initial price of the 5% debentures. For readers who may be interested in this ingenious arrangement, we set forth our solution in Appendix 4. Other unusual items. Number 1, right after the close of 1969, the company bought in no less than 650,000 warrants at a price of $9.38 each. This was extraordinary when we consider that A, NVF itself had only $700,000 in cash at the year end and had $4,400,000 of debt due in 1970. Evidently, the $6 million paid for the warrants had to be borrowed. B, it was buying in this warrant paper money at a time when its 5% bonds were selling at less than 40 cents on the dollar, ordinarily a warning that financial difficulties lay ahead. 2, As a partial offset to this, the company had retired 5,100,000 of its bonds along with 253,000 warrants in exchange for a like amount of common stock. This was possible because by the vagaries of the securities market, people were selling the 5% bonds at less than 40, while the common sold at an average price of 13.5, paying no dividend. The company had plans in operation not only for selling stock to its employees, but also for selling them a large number of warrants to buy stock. Like the stock purchases, the warrants were to be paid for 5% down and the rest over many years in the future. This is the only such employee purchase plan for warrants that we know of. Will someone soon invent and sell on installments a right to buy a share, or so and so on? 4. In the year 1969, the newly controlled Charon Steel Company changed its method of arriving at its pension costs and also adopted lower depreciation rates. These accounting changes added about $1 per share to the reported earnings of NBF before dilution. 5. At the end of 1970, Standard & Poor's Stock Guide reported that NBF shares were selling at a price-earnings ratio of only 2, the lowest figure for all the 4,500-odd issues in the booklet. As the old Wall Street saying went, this was important if true. The ratio was based on the year's closing price of 8 3/4 and the computed earnings of $5.38 per share for the 12 months ending September 1970. Using these figures, the share was selling at only 1.6 times earnings. But this ratio did not allow for the large dilution factor, nor for the adverse results actually realized in the last quarter of 1970. When the full year's figures finally appeared, they showed only $2.03 per share earned for the stock, before allowing for dilution, and $1.80 per share on a diluted basis. Note also that the aggregate market price of the stock and warrants on that date was about $14 million against a bonded debt of $135 million. A skimpy equity position indeed. Aaa Enterprises History. About 15 years ago, a college student named Williams began selling mobile homes, then called trailers. In 1965, he incorporated his business. In that year, he sold 5,800,000 of mobile homes and earned $61,000 before corporate tax. By 1968, he had joined the franchising movement and was selling others the right to sell mobile homes under his business name. He also conceived the bright idea of going into the business of preparing income tax returns using his mobile homes as offices. He formed a subsidiary company called Mr. Tax of America, and of course started to sell franchises to others to use the idea and the name. He multiplied the number of corporate shares to 2,710,000 and was ready for a stock offering. He found that one of our largest stock exchange houses, along with others, was willing to handle the deal. In March 1969, they offered the public 500,000 shares of Aaa Enterprises at $13 per share. Of these, 300,000 were sold for Mr. Williams' personal account, and 200,000 were sold for the company account, adding 2,400,000 to its resources. The price of the stock promptly doubled to 28, or value of $84 million for the equity, against a book value of, say, $4,200,000 and maximum reported earnings of $690,000. The stock was thus selling at a tidy 150 times its current and largest earnings per share. No doubt Mr. Williams had selected the name Aaa Enterprise so that it might be among the first in the phone books and the railroad pages. The collateral result was that his company was destined to appear as the first name in Standard & Poor's Stock Guide. Like Abu Ben Abdon's is led all stock as the first name in Standard & Poor's Stock Guide. Like Abdu Abdon, it led all the rest. This gave a special reason to select it as a harrowing example of 1969 new financing and hot issues. Comment. This was not a bad deal for Mr. Williams. The 300,000 shares he sold had a book value in December of 1968 of $180,000, and he netted, therefore, 20 times as much, or a cool $3,600,000. The underwriters and distributors split $500,000 between them, less expenses. See? That's it. And I'm done right here. Okay? 2. This did not seem so brilliant a deal for the clients of the selling houses. They were asked to pay about 10 times the book value of the stock after the bootstrap operation of increasing their equity per share from 59 cents to $1.35 with their own money. Before the best year, 1968, the company's maximum earnings had been a ridiculous 7 cents per share. There were ambitious plans for the future, of course, but the public was being asked to pay heavily in advance for the hope for a realization in these plans. 3. Nonetheless, the price of the stock doubled soon after original issuance, and any one of the brokerage house clients could have gotten out at a handsome profit. Did this fact alter the flotation, or did the advance? Yes, or did the advance possibility that it might happen exonerate the original distributors of the issue from responsibility for this public offering and its later sequel? Not an easy question to answer, but it deserves careful consideration by Wall Street and the government regulatory agencies. Subsequent history. With its enlarged capital, Aaa Enterprises went into 2 additional businesses. In 1969, it opened a chain of retail carpet stores, and it acquired a plant that manufactured mobile homes. The results reported for the first 9 months were not exactly brilliant, but they were a little better than the year before, 22 cents a share against 14 cents. What happened in the next months was literally incredible. The company lost $4,365,000, or $1.49 per share. This consumed all its capital before financing, plus the entire $2,400,000 received on the sale of stock, plus 2/3 of the amount reported as earned in the first 9 months of 1969. There was left a pathetic $242,000, or 8 cents per share of capital for the public stockholders, who had paid $13 for the new offering only 7 months before. Nonetheless, the shares closed the year 1969 at 8 1/8 bid, or a valuation of more than $25 million for the company. Further comment 1. It is too much to believe that the company had actually earned $686,000 from January to September 1969, and then lost $4,365,000 in the next 3 months. There was something sadly, badly, and accusingly wrong about the September 30 report. 2. The year's closing price of 8 1/8 bid was even more of a demonstration of the complete heedlessness of stock market prices than were the original offering price of 13 or a subsequent hot issue advance to a high bid of 28. These later quotations, at least, were based on enthusiasm and hope, out of all proportion to reality and common sense, but at least comprehensible. The year-end valuation of $25 million was given to a company that had lost all but a minuscule remnant of its capital, for which a completely insolvent condition was imminent, and for which the words enthusiasm or hope would be only bitter sarcasms. It is true, the year-end figures had not been published by December 31st, but it is the business of Wall Street houses associated with a company to have monthly operating statements and a fairly exact idea of how things are going. Final chapter. For the first half of 1970, the company reported a further loss of $1 million. It now had a good-sized capital deficit. It was kept out of bankruptcy by loans made by Mr. Williams up to a total of $2,500,000. No further statement seemed to have been issued until January 1971. Aaa Enterprise finally filed a petition in bankruptcy. The quotation of the stock at month end was still 50 cents a share, a share bid, or $1,500,000 for the entire issue, which evidently had no more than wallpaper value. End of our story. Moral and questions. The speculative public is incorrigible. In financial terms, it cannot count beyond 3. It will buy anything at any price if there seems to be some action in progress. It will fall for any company identified with franchising, computers, electronics, science, technology, what have you, when the particular fashion is raging. Our readers, sensible investors all, are of course above such foolishness, but questions remain. Should not responsive investment houses be honor bound to refrain from identifying themselves with such enterprises, 9 out of 10 of which may be foredoomed to ultimate failure? This was actually the situation when the author entered Wall Street in 1914. By comparison, it would seem that the ethical standards of the street have fallen rather than advanced in the ensuing 57 years, despite all the reforms and all the controls. Could and should the SEC be given other powers to protect the public beyond the present ones, which are limited to requiring the printing of all important relevant facts on the offering prospectus? Should some kind of box score for public offerings of various types be compiled and published in conspicuous fashion? Should every prospective and perhaps every confirmation of sale under an original offering carry some kind of formal warranty that the offering price for the issue is not substantially out of line with the ruling prices for issues of the same general type already established in the market? As we write this edition, a movement toward reform of Wall Street abuses is underway. It will be difficult to impose worthwhile changes in the field of new offerings, because the abuses are so largely the result of the public's own heedlessness and greed. But the matter deserves long and careful consideration. Okay, so that's the end of it. I did hear that there is a boom in stock buying for any company with Zoom in the title, even if it is the actual Zoom company or not, because of this recent COVID crisis. So there you have it. The public is not paying much attention. They'll buy pretty much anything, even if it's crappy. So that's the chapter. Pretty cool. Okay, well, thanks for joining me. I'll see you again tomorrow. Bye. Have a nice day. Bye-bye.